Know the Difference with Annex Wealth Management, joined by Eric Strom, Financial Planning Manager and a CFP at Annex Wealth Management. Welcome.
Hi, Danny.
Senate leaders unveiled a $1.7 trillion year-long federal government funding bill early Tuesday morning. It includes $773 billion for non-defense discretionary programs, $858 billion in defense funding, and that is according to the Senate Committee on Appropriations. There soon may be new retirement rules in place that could make it easier for Americans to accumulate retirement savings and make it less costly to withdraw them if lawmakers pass a major spending package. Retirement savings provisions are known as Secure 2.0. There are numerous provisions in the package, known on Capitol Hill as an omnibus, based on breakdown from the Senate Finance Committee. Eric, I don't think you've read all 4,000 pages of this proposed bill, but it's a big one.
It is a very big one.
What do we have to look at? There's a number of changes.
Huge number of changes. Nearly everyone will be affected by at least something within these provisions. Maybe we can do a little bit of a lightning round and really try to cover some of these. At this moment, it's widely believed that this is a virtual certainty to pass, just if you look at the circumstances there. And one of the most major changes, Danny, would be another backup for the RMD Start Age. So required minimum distributions, they used to start at age 70 and a half. We all knew that number, was backed up to 72 by the Secure Act 1.0. Here, we would see an immediate backing up to age 73 starting in 2023. What that would mean, that would go into immediate effect. And then starting in 2033, we'd actually see a backing up to age 75. So that's a very large shift from what we had before.
Based on what you've seen from our clients, would this be a popular thing?
Very popular because we have many clients engaging in tax planning strategies that are trying to take advantage of that time before those required minimum distributions begin. So this would just help that effort even more.
Great. How about a 401k catch-up contribution? That is also changing.
This is a pretty big deal. So this particular provision wouldn't start until 2025, but we'd see the 401k catch-up contribution limit increasing for those ages 60 through 63. So remember, there's already a catch-up starting at age 50. This would add so-called extra catch-up starting at age 60 through 63, and the catch-up would actually be increased to $10,000 or 150% of the normal catch-up, whatever's larger. But here's the kicker, Danny. For higher income taxpayers, guess what? They're going to require that this catch-up contribution be Roth rather than getting that tax deduction right away. So that's actually going to affect quite a few people out there who are saving, because a lot of people, Danny, are actually playing catch-up. That's why they're called catch-up, provisions. And so in this case, that requiring it to be Roth is a very big change. Here's another one. Companies can offer their 401k matches in a different way. So a lot of people who have jobs out there get a 401k match. And when that happens, the company actually takes a tax deduction, and then you get money added to your pre-tax side. Now the company is going to have an option to actually offer that match in Roth. But here's the downside. The downside is that the employee would actually be taxed as if they earned that income. So a pro and a con there.
A change in 529 plans?
Yeah, so this could be good news for those who either have done this or are worried about overfunding their child's 529 plan. So this would actually allow beneficiaries of 529 plans to roll over up to $35,000 over time from 529 plans over to a Roth IRA. However, the beneficiary would have certain limitations. For example, they would have to be qualifying to make those Roth IRA contributions in the first place, and there would be other severe limitations as well to stop gaming the system. But this is actually welcome relief for those who put too much into their child's or other beneficiaries' 529 plans.
Nice to see more options for self-employed individuals.
Yes. Many smaller businesses might use certain retirement plans such as SEP IRAs or simple IRAs. What is really interesting is now there would be Roth SEP IRAs and Roth simple IRAs. So you're seeing a lot of Roth here. And by the way, Congress loves Roth because it brings those tax dollars in now. And although the remaining balances grow tax-free, that's a problem for future humans, right? So Congress loves bringing in that Roth element. But this actually is great for, let's say, you're an independent real estate agent or some other self-employed person and you're saving. Now you'll have a Roth option. And that's a good thing.
One of the scariest things was the penalty for missing your RMD, and it was hefty.
Yeah, a whopping 50%. So this provision will reduce greatly that penalty down to 25% or, in many cases, 10% as long as it's resolved quickly. That is a good thing. However, it's important to understand that the IRS was pretty forgiving with that 50% penalty. If you could substantiate that you had extenuating circumstances, the IRS was very good about that penalty and having that forgiven. But with the new penalties, it's widely believed by experts that the IRS is not going to be so forgiving with these smaller penalties.
We speak a lot about qualified charitable distributions. There's a proposed change there.
This provision would greatly expand qualified charitable distributions. The limit would be doubled, so you'd be able to make larger qualified charitable distributions, and there would be a new strategy where in some cases you could make a QCD into a certain type of charitable remainder trust. So a certain estate planning strategy that might be a good fit for some to look into.
What are the proposed changes for people trying to access retirement plan money before the age of 59 and a half?
We're going to see potentially here multiple new exceptions to the 10% early withdrawal penalty. So a notable one is emergencies. So in emergency situations, you could take up to $1,000 out of a retirement plan with no 10% early withdrawal penalty. There would also be provisions added for terminal illness, domestic abuse, and interestingly, qualified long-term care distributions. If you're purchasing long-term care insurance, you could potentially pay those premiums directly from a plan without that 10% early withdrawal penalty, which is pretty interesting.
A few more points in what is tucked into Secure 2.0. This is new type of account, the emergency savings account. Explain that.
Employer-sponsored retirement plans such as a 401k would obtain a new type of almost a sidecar account called an emergency savings account attached to that plan. Now, highly compensated individuals would not be able to utilize these, but for all others, you could put up to $2,500 into this emergency savings account as tied to your employer plan at work. It would have to be held in a cash type account, like an interest, similar to a savings account, but you'd be able to take that money out tax-free and penalty-free as long as you follow the rules, and it just acts as almost like a rainy day fund, but it's attached to your employer plan at work. So pretty interesting concept.
Something interesting in there about student loan borrowers.
Student loan borrowers sometimes must choose between paying their loan and getting a 401k match, because that 401k match, oftentimes you have to make contributions to get that. But if your dollars are going towards paying off the loans, that can make you make a difficult choice. This provision would allow employers to actually make a matching contribution to an employee's plan based on the fact that the employee is actually making qualified student loan payments. So that is welcome relief to borrowers who can't afford to do both. They could still potentially get that match. That's a good thing.
What is the Savers Credit?
The Savers Credit helps lower income taxpayers save for retirement and then actually get a special tax credit for doing so. The limits have been pretty low in the past, but the Savers Credit would actually become enhanced, so it would get larger, and more families and households and individuals would become eligible for this credit, which helps a lot of everyday Americans really save for retirement and have a nice benefit for doing so.
There's some good news in here about part-time workers, finally, for 401ks.
Companies would have to cover more part-time workers with their retirement plans, such as a 401k. And this is a very good thing because there's a lot of part-time workers out there, and it would help them save more effectively for retirement. And similar, by the way, we've got companies would actually be required to auto-enroll workers in new retirement plans. Right now, it's optional. And this requirement would mean more people potentially being a part of retirement plans automatically.
And we'll close on one more Roth thing, and that's a Roth 401k.
Yeah, under current law, strangely, if you have a Roth 401k, there's actually required minimum distributions that come out of those accounts. But that's not the case for Roth IRAs. So in the past, you would have to make sure that you roll over your Roth 401ks to a Roth IRA so that you can escape that required minimum distribution. That would be resolved with this provision.
The proposed changes in Secure 2.0 needs to become law, but we thought we would cover those for you if you're interested. Eric Strom, Financial Planning Manager and a CFP at Annex Wealth Management. Thank you.
Thanks, Danny.